Hello and welcome to this video. In this video on financial analysis, I would like to show a very important concept of the financial analysis, and that's the return on investment concept. I have combined this concept with the leverage effect here because I would like to show up two measures: the return on equity and the return on capital employed. And the difference between those two measures can only be understood if I also show up the leverage effect. That's why I combined those two things. So, first we need to get to know the return on investment concept. Then we get to know the first measure, return on equity. Then the second measure, return on capital employed. Then we go into the difference, being the leverage effect. We're going to visualize all that, and we're going to talk about the leverage risk. First of all, I need an empty page to explain the return on investment concept. And that's pretty easy because the return on investment, ROI, is defined as the return over the investment. This is just a concept, not a measure on its own. Later on, we're going to get to know return on equity, return on capital employed, that are real financial ratios. The return on investment is just a concept. This basic concept is based on the idea of making things comparable with interest rates, because interest rates are also return on investments. Let me make a little example on that. Let us assume we put some $100 on our savings account. And at the year's end, we get some $5 of interest on that. Accordingly, the interest rate can easily be calculated as the return, which is $5, divided by the investment, that was $100, and that is 0.05 or 5% equivalently. So accordingly, the interest rate is a very simple return on investment concept. Well, can we now apply this to a company to make it comparable with interest rates, with other companies, or with the year before? Because all those financial ratios are typically compared with other companies of the same industry, or with the previous year's financials to see if something has improved or worsened. And in this case, we can also compare it with market interest rates. Well, what do we have invested into this company? Let's say the founder of the company has invested the total equity. So this is the investment under the assumption that this company is still held by the founder. Of course, someone who has bought some shares at the equity market might have paid a completely different sum. Nevertheless, let us assume this. And now the question is, what does this person earn? And this person, of course, earns the dividend. We know that the dividend is paid out of the net income, so the net income will be distributed as a dividend. But there's also a second alternative. So if the shareholder meeting decides to retain the earnings, they can also do that. The decision that is made here is what we call the dividend policy. Okay, so we can now apply the return on investment concept on the dividend. And what we get is the so-called dividend yield. And the dividend yield is thus defined as the dividend divided by the equity. Of course, I mean, if I say dividend, the whole amount of dividends paid out and not the dividend of a single share. Well, we do not know about the dividend in this case. Let us just assume that the dividend is 500 here, $500 million. So we have to divide 500 by 21,098. And that is, I just grabbed the pocket calculator. That is 0.023, or equivalently 2.3%. Well, since we are today in an environment where you nearly earn no interest, 2.3% return on investment or dividend yield is not that bad if not too much risk is involved. Okay, but of course the dividend yield is highly dependent on the dividend policy. Because if the shareholder meeting decides to retain all the earnings, the dividend will be zero, and the dividend yield will be zero accordingly. So the dividend yield might not be the best idea to compare it with other companies, because this decision about the dividend policy may distort this measure a lot. Well, so what else can we do? What else do we find what does not underlie the dividend policy? Of course, the net income. So, if we now apply the return on investment concept to net income, we call it the return on equity. Or simply ROE. The return on equity is defined as net income divided by equity. Or in this particular case, of course, 1,703 divided by 21,098, and that is 0.08 or 8% equivalently. So, if we would have bought this company, we would now have a return on equity of 8%. Not bad. We still face another problem, because the net income is not really depending, or not only depending, on the operative business that is reflected in the operating income or EBIT, but we also see all the financial results that are given here. So also the return on equity is distorted by the so-called financial policy. Honestly speaking, the same is true for the dividend yield. The dividend yield is distorted by the dividend policy and the financial policy. The return on equity is only distorted by the financial policy. Thus, the return on equity underlies the leverage effect. We will later see what that means, but I will write it down here. Return on equity So, if we want to have a more robust measure, a return on that is more robust towards financial policy, towards decisions made by the management, we must further go up. We went up from the dividend to the net income, and now we go up further to the EBIT. Doing so, we end up in a measure that we call return on capital employed. The return on capital employed is defined as EBIT and now divided by equity plus long-term debt. Well, we can discuss a little if long-term debt is really the right measure here. The idea is to have the interest-bearing debt here. So loans and notes payables and current maturities of long-term debt might both also be interest-bearing and can also be added here. That's a question of definition. What we see in the denominator here is called the capital employed. And that's why it's called return on capital employed. So the capital employed can be defined as equity plus debt. So this area here. But it can also be defined, and we come back to that idea later, as assets minus short-term debt. Assets minus short-term debt will be the same, of course. So it's just a different idea how to think about capital employed. So in this particular case, we would now divide 2,435 by 2198 plus 38,310, and that is 0.04 or 4% equivalently return on capital employed. Well, why now do we take into account total equity and liabilities and the interest-bearing debt down here? Because the EBIT is before financing. It is earnings before interest and taxes. Or in other words, this operating income has to be split into interest expenses and net income. So this is still to be split among the investors. Among both investors, equity, so shareholders, and bond or bank or debt investors. Among both groups of investors. So, if the EBIT is something before financing, before splitting among both groups of investors, of course we have to divide by the investment of both groups, because it's return on investment, and this is a return. The EBIT is a return to both investors, so we also have to put the investment of both investors in the denominator here. And that's the reason why we divide EBIT by equity and long-term debt. Well, the difference between return on capital employed and the return on equity is the leverage effect. And I would like to use some mathematics to show up how they interact. I would like to put a very simple, or I just go back. I would like to put this particular part of the income statement into a formula. So this formula looks like this. The net income, NI, is given by the EBIT minus the interest. I just assume that there is only interest payments and no other financial results. And of course, EBIT minus interest will give the earnings before income tax. So we have to deduct the income tax. And we do this since the income tax is combined multiplicatively. I just use the term 1 minus t, with t as the tax rate. So this is a formula for the lower part of our income statement. Well, if we now divide both sides by equity, of course we will have the return on equity on the left side. Since the return on equity is defined as net income divided by the equity. On the right-hand side of the formula, I can now decide which part of the formula I want to divide. I decide for the brackets here, and I could now divide the whole bracket or each individual item. I decide for each individual item. So I have the bracket here with EBIT divided by equity minus interest divided by equity times 1 minus t. Okay, now I do something curious. I would like to multiply this ratio by 1, expanding the fraction. So, return on equity is then, again the bracket, EBIT divided by equity. And now I multiply by a new fraction line that I just introduced here, and that is equity plus let's say long-term debt, LTD. Oops, I'm sorry. Long-term debt. Or non-current liabilities. I guess that's better. Non-current liabilities. And we do this in the enumerator and in the denominator. So this fraction line is in fact 1. Well, and I do something different with this fraction line. The interest amount here can also be split into an interest rate and the interest-bearing debt. So minus the interest rate that I call RD, like return on debt or whatsoever. And here we have the non-current liabilities again divided by the equity. So you see that interest rate times interest-bearing debt, that's the interest amount. So this is exactly the same. And again times 1 minus t. Now I would like to swap, because here we have a multiplication sign, times. I would like to swap the denominators of these two fraction lines. So the return on equity is now given by the EBIT divided by equity plus non-current liabilities. And we already see that this is the return on capital employed. Times the equity plus non-current liabilities divided by equity, because we have swapped, this equity is now here, minus RD, so here everything stays the same, times 1 minus t. All right. Of course, here, equity divided by equity, we can simplify this, this fraction line further. So return on equity accordingly is now return on capital employed times 1 plus non-current liabilities divided by equity. And here everything as usual. And 1 minus t. Okay, I need a bit of space. I now continue here. Well, we now can get rid of those brackets, of course. So the return on equity is then given by the return on capital employed times the return on capital employed times non-current liabilities divided by the equity minus, oh, something's wrong. Here's a plus, of course, because we multiply rho C with 1 and we multiply rho C with this, but there's a plus in the middle. And minus our D non-current liabilities and the equity, and again 1 minus t. And now, of course, we can do a last little thing. Return on equity is now return on capital employed plus, brackets again, return on capital employed minus the interest rate times non-current liabilities divided by the equity, closing brackets, and 1 minus t. And this now is the so-called leverage, this is now called the leverage formula. All right, I just clean up a little. Okay. Now let us analyze this formula a little. First of all, we still see the 1 minus t here. This is very unusual, so if you look into the textbooks, you often won't find this expression there. But obviously here it is right, the textbooks are wrong. So we need to write down that the ROE is an after-tax measure while the return on capital employed is a pre-tax measure. So this is important point number 1. But this is not the most important point. A second point is that this ratio here, so debt divided by equity, is called the leverage ratio. So let's write that down. Point number 2. Debt, interest-bearing debt, or in this case non-current liabilities, divided by the equity is called leverage ratio. It is closely related to the debt ratio, but it has to be interpreted as a kind of multiplier, how often the amount of debt exceeds the amount of equity. So it's like a multiplier of debt over equity. The third thing is this part of the formula. There's some kind of margin. The margin rho C minus the interest rate. So the rho C, we just have seen that the rho C is the return of all the assets minus the short-term debt. So how much does our capital earn? And the interest is how much our debt costs. We now have to differentiate. So if the margin rho C minus interest is 0, then we see it here. If it is 0 and the leverage ratio is whatsoever, then the return on equity and the rho C are the same, but the tax. The same is of course true if our leverage ratio is 0. If our leverage ratio is 0, then again, return on equity and rho C are the same, but the tax. But the tax, because return on equity and is an after-tax measure and return on capital employed is a pre-tax measure. But of course, we need to take a look, and this is 3a. We need to take a look what happens if this margin here is not 0 and if the leverage ratio is not 0. Let us first assume that the return on capital employed exceeds the interest rate. And that is a healthy situation, of course. So let's pretend this is plus and leverage ratio is also plus. A positive number times a positive number will give a positive number. So the return on equity will be higher than the return on capital employed because you will add something to the return on capital employed, something positive. I write down ROE gets higher, or it's increasing, right? ROE gets higher, and this is what we call the leverage effect. Okay. But what happens if the margin is negative? The leverage ratio can never be negative. It can just be 0. There's no chance to have a negative. with just one exemption, that the company is over-debted and thus bankrupt. That's an alternative. When the equity here is negative, of course, the whole fraction line will be negative. Nevertheless, normally the leverage ratio should not be lower than 0, but the margin could be. So if the return on capital employed is smaller than the interest rate, and of course we have some leverage, so leverage is not 0, it exceeds 0, then the ROE gets lower or even negative. We can call this the negative leverage effect. And then this one can lead to a catastrophe. I would like to show you how that looks like if we visualize this situation. Here we see two graphs. On the left-hand side, we see the positive situation. So the return on capital employed exceeds the interest rate. The interest rate is given here, and assumingly the interest rate does not change with leverage. Leverage is given here, so we start in a situation where the leverage is 0, we have a certain interest rate, but since we are now in the positive situation, so interest rate is here, return on capital employed is higher than the interest rate. Then the return on equity will start a little lower. This is due to the fact that we have to multiply it with 1 minus t, so we have to deduct the tax. Return on equity is thus lower. Nevertheless, the return on equity rises with the slope ρ minus interest rate. So that's the slope of this curve, because the slope is then multiplied with the leverage and it's going up. Well, so seemingly we can lever, and that's where the name comes from, ROE upwards. With leverage, the ROE is rising as long as return on capital employed exceeds the interest rate. If this is not the case, if the return on capital employed falls below the interest rate, and do we really have this in hand? So if just an economic downturn is coming, our ROCE might turn down, then the leverage goes into the different direction. Here we have the interest rate here, and the ROCE has fallen below the interest rate, maybe due to an economic downturn. Again, a little deeper starts in the starting situation, the ROE, and now it's going down because the slope is ROCE minus interest, and since this one is negative, here we have the reason, the ROE is going down. If we now compare two situations, I'm just cleaning up a little. If we now just compare those two situations, a low a low leverage situation, I'm going to add the bad situation. So this situation, I'm going to add this here. And we now have a low leverage situation given here. And a high leverage situation given here. We already see what happens. So all other figures fixed, with a high leverage, we see an enormous volatility in our results. While with low leverage, we see just a low volatility in our results. So we can already see visually with leverage, the risk is rising. We have to differentiate between the operating risk and the leverage risk course, the leverage risk levers the operating risk, just like the ROCE is levered, or the ROE is levered, the risk is levered too. I would like to show you this with in mathematical terms. I just pick the same formula, the leverage formula. ROE is given by ROCE. That is now meant to be not constant, so a random number, plus ROCE, again random, minus the interest rate, times our leverage ratio, and in brackets, times 1 minus t. I now apply the variance function on both sides. So let's take a look at the variance of the return on equity. That is equal, of course, to the variance here on our right-hand side. ROCE as a random number. ROCE as a random number minus the interest rate times the leverage ratio and times 1 minus t. We can now apply the rules for the variance and take a look what is varying and what is not varying. Varying is of course only the ROCE, but not the leverage, not the interest, not the tax. So we can rearrange the whole formula. The variance of return on equity is accordingly, we have to multiply this out again, of course, so we have to solve all those brackets, and then we end up in the variance of the ROCE which is varying, of course, times 1 plus the leverage. And that is squared here, times 1 minus t, and this one is squared too. So the only thing that is varying is the ROCE, and it has a certain variance. And obviously this variance drives the variance of the return on equity. But there are a few parameters that also drive the variance of the return on equity, and these are constant. They are not varying on their own. And what do we see here? We see 1 plus the leverage ratio. The leverage ratio is 0 or positive. So we multiply the variance of ROCE with 1 plus a positive number squared. Accordingly, leverage levers the risk of ROE in terms of its variance. So here we have the mathematical formulas or the mathematical proof why the return on equity, the risk of the return on equity, is also levered with leverage. I hope you enjoyed the video. Thank you for listening and see you in the next video.